We think cash actually is still growing at about 3 or 4% around the world. That's cash in circulation, which is driven by a number of things. Population growth and GDP growth actually just mean there's more cash in circulation. About 85% of all transactions globally are cash-based. Many people don't have bank accounts, and so the only way that they can transact is through cash. They can't get access to credit cards or other payment mechanisms. So actually we see cash as a very robust payment mechanism which will be part of a payment ecosystem for many years to come. De La Rue operates in three markets: banknotes, identity solutions, and product authentication. So if I take each of those in turn, in the banknote market, that is a growing market, slightly counterintuitively. The amount of cash in circulation continues to grow globally, and that is driven by population growth and by GDP growth. And actually cash is still very, very widely used around the globe. In the identity market, there's an emerging middle class. So as countries like China and India and so on become wealthier, there's an emerging middle class, which means there are more people traveling around the world in a world which continues to be, in some senses, unsafe. And so identity documents like passports and ID cards remain critically important to citizens and to governments. So that drives growth there. And in the product authentication market, there are two segments in there. One is brand protection. And as more and more retail moves online, more and more people are concerned that the thing they bought online is the genuine article. So that's driving growth in brand protection. And in the tax stamp part of that business for us, there's increased legislation in place across many countries across Europe and more broadly across the globe, which is driving more and more countries to put tax stamps on alcohol and tobacco. So all of the three markets that we're exposed to are actually growth markets. In terms of our competitive strengths, the key thing that De La Rue does is it creates documents or tokens which are difficult to counterfeit. So we've put a lot of investment over the last few years into research and development to increase the number of patents that we have, the number of patents that we file. That means that we can defeat the counterfeiters. We can create things which are too difficult for them to counterfeit. We updated the market on a revised strategy for the group in May 2015. And the strategy we set out at that time really was to deal with some of the risks that we saw within the business and to see if we could tap into some upside growth opportunities. The risks really were around predominantly our banknote business. We've sold a couple of non-core assets. We sold our cash processing business. And we've also in the last financial year sold our paper business. And both of those were businesses we didn't really see fitting very well within the group. We've also reduced the capacity within our banknote print business to ensure that we can have higher utilisation. So all those we saw as risk areas, we've addressed all of those risks. In terms of the growth opportunities, we were seeking growth in security features, in the identity market, in the product authentication market, and in polymer. We've entered the polymer market. There used to be a single monopoly supplier. We are now one of two suppliers, and we've taken a 15% market share. So I'm pleased with progress there. We've hugely increased our investment in research and development, which means we have far more patent filings, far more new security features that we're bringing to market, which has underpinned underlying growth in that part of our business. And then perhaps kind of most excitingly, really looking forward for growth, our product authentication business, we said at our half-year results would double in size over the next 3 years. And that, again, is driven by a very strong order book, very strong order intake in the last year, underpinned by the investments we've made in research and development. All of that, whilst all those things have been going on, we've also deleveraged our balance sheet enormously. We've reduced our pension deficit from over 200 million to about 77 million, and we've reduced our net debt. So we now have a platform which I think will enable us to drive the business forward. Our UK passport contract is about half of our identity business as we stand today. And so with the loss of that contract, obviously that's a catalyst for us to start thinking a little bit about the strategy of that business moving forward. And we did a piece of work over the summer to look at the strategy for the identity business and updated the market at our half-year results. What we concluded was if we lose half of the size of the business, we don't really have the size and scale to compete as a prime systems integrator in the identity market anymore. And that's a market where the supply base has consolidated quite a lot over the last few years. So our focus moving forward is going to be to focus on security components and security features into the identity market, where we can sell those into the prime systems integrators, or actually perhaps more importantly, we can sell them directly into the state sector for those countries who are making their own passports. So we still think it's a growing market, and we still think we have a viable way forward there, but not as a prime systems integrator. We set out at our half-year results for the first time a very clear capital allocation strategy, if you like. And we broke it down into three areas. Our highest priority is to continue to invest organically in the business, followed very closely by maintaining our dividend. And now that we've deleveraged our balance sheet, we absolutely think we can maintain our dividend at least at the current level. And then our third area of priority is to take the deleveraged balance sheet and use it to drive investment in inorganic activities. So if there are bolt-on acquisitions, particularly focused on our growth areas, then we will look very seriously at those. We also said that we don't want to leverage the balance sheet up beyond a 1.5 times net debt to EBITDA. We're a contracts business. The contracts can be quite lumpy. Our working capital can be quite lumpy. And so we feel that's a very prudent level at which to set the net debt to EBITDA ratio.